Welcome to the Deep Dive, the show where we really try to, cut through all the noise.
And get straight to the insights that matter.
Exactly. Today, we're going after a really common idea in investing, that old chestnut. Buy low, sell high.
Yeah, sounds like just plain common sense, doesn't it?
It really does. But, well, what if that's not the whole picture? What if the actual secret to making consistent money in the market isn't about chasing the news or hanging on every word from some guru?
What if it's about understanding the market's own language?
Precisely. What if it's about reading the signs the market itself gives you?
That's the core idea here. The market, you see, is incredibly good at discounting future events.
Yeah.
It moves way before the headlines actually hit. It's pricing in what's going to happen with earnings, not just what's happening right now.
So the pros, the ones who are really making money consistently, they're not watching financial TV all day.
Not usually, no. They're looking at market action. Price, volume, that's the objective data. They're kind of playing a different game.
Okay, I'm intrigued. Let's dive into those rules. Our source material for this deep dive is Stan Weinstein's classic 1988 book, Secrets for Profiting in Bull and Bear Markets.
And just to be clear, this isn't some get-rich-quick thing.
Right. No magic formulas here. Weinstein lays out a really disciplined, technical method for understanding how markets move. And his promise is, well, pretty compelling.
The ability to consistently profit, often needing just, say, an hour a week for analysis once you get the hang of it.
Which sounds amazing. And his core philosophy, you mentioned professionals buy high and sell higher. That sounds completely backwards.
It does initially, but it's about reading the message of the tape, as he calls it. Basically, all the fundamental stuff, earnings, products, management, you name it, it's already baked into the stock's price and how it's trading.
So our mission today is to help you, the listener, figure out how to spot those clues, the ones most people just fly right past.
Exactly. And it really starts with understanding a stock's life cycle. Weinstein breaks it down into 4 stages. Every stock, always, is in one of these 4.
Always, no exceptions.
Always. The trick is just identifying which one.
Okay, what are they?
You've got stage 1, the basing area, stage 2, the advancing phase, stage 3, the top area, and stage 4, the declining phase.
All right, let's break those down. Stage 1, the basing area, what's happening there?
Okay, think of stage 1 as like a recovery room for a stock after it's had a big fall. It's consolidating. On a chart, the long-term price average, let's use the 30-week moving average like Weinstein does. It's flattening out, maybe just starting to try and curve upwards.
So it's stopped going down, basically?
Pretty much. And this is often where the really big players, the institutions, they start quietly buying up shares. There's usually no good news out yet. Maybe the news is still bad.
While the average person is probably still selling, right? Still hurting from the drop.
Exactly. They're discouraged. So stage 1 is that quiet accumulation phase.
Okay. Then comes stage 2, the advancing phase. This sounds like where the action is.
This is absolutely the sweet spot. This is where you want to be buying. The stock breaks out. It pushes above that sideways basing area, above the resistance, and crucially, above that 30-week moving average. And that average must be pointing upwards.
And volume is important here, right?
Oh, huge. That breakout needs to happen on really impressive volume. A big surge in buying interest. It shows conviction.
But the news might still be bad? That's the crazy part.
That's the counterintuitive kicker. Often, at the ideal buy point, the headlines are still negative, or maybe just neutral. The market's already looking ahead, discounting better times to come.
Wow. Okay, so buy when the chart says go, even if the news hasn't caught up. That's a big takeaway.
It really is. And often, after that first strong burst upwards in stage 2, you'll see a pullback, a little dip.
Okay.
That dip often brings the price back near the original breakout level. Weinstein calls this a second chance buy point. It's a lower risk entry. Stocks in stage 2 can just keep climbing, sometimes for a very long time with little corrections along the way, but generally staying above that rising 30-week average.
Fantastic. But like you said, every stock is in one stage. So stage 2 doesn't last forever. What happens in stage 3, the top area?
Right. Stage 3 is where the trend starts to stall out. The 30-week moving average flattens. The stock stops making new highs and starts trading sideways, often in a wide, choppy range.
So it looks kind of neutral.
Exactly. And that's what makes it dangerous. Because while it looks neutral, this is actually a period of distribution. The smart money, the institutions that bought back in stage 1 and early stage 2, they're now quietly selling.
Selling to who?
To the public, typically. The latecomers who are finally getting excited because now the news is great, maybe there's a stock split, earnings look fantastic, all the good stuff seems to be happening, but the stock itself isn't really going anywhere.
So the positive headlines are actually a warning sign at this point, potentially.
Often, yes.
Yeah.
It's the exact opposite of stage one accumulation. This is distribution.
A vital distinction. Okay, that leads us grimly into stage 4, the declining phase. I think I know what this looks like.
Yeah, this is the worst place to be. The stock breaks below its support levels, below that sideways stage 3 range, and crucially, the 30-week moving average decisively turns down.
Does volume matter on the breakdown?
A big spike in volume on the breakdown is definitely bearish, confirms the selling pressure. But here's the thing. A breakdown in light volume is still really dangerous.
Hmm.
Stocks can just sort of collapse under their own weight once the support gives way.
And this is where people make that big mistake of averaging down.
Oh yeah, the classic bargain hunter trap.
Hmm.
Buying more shares as the price falls, thinking, oh, it's cheaper now, it must be a deal.
And that usually ends badly.
It's often financial quicksand, as Weinstein puts it. You just keep throwing good money after bad. The market doesn't give a whit what you paid for the stock. If it's in stage 4, the message is clear. Get out. Don't rationalize, don't hope. Just exit.
Brutal, but clear.
Right.
Okay, so we know the stages. How do we use this to actually pick stocks? You mentioned Stan's forest to the trees approach.
Right, it's a very logical 3-step process. Step 1, assess the overall market trend. Is the whole forest, the broad market, generally bullish or bearish? You absolutely don't want to be buying stocks if the overall market is in a stage 4 decline.
Don't fight the tide. Makes sense. How do you determine that overall trend?
Weinstein uses a range of long-term indicators, looking at the major averages like the Dow or the S&P 500, applying the same stage analysis to them. We can get into those specific indicators a bit later.
Okay, so first the market, then what? Step 2.
Step 2 is sector selection. Once you know the market's general direction, you identify the strongest industry groups within that market. Which sectors are showing the best technical strength?
Why is that so important?
Because a strong stock in a strong group will almost always outperform an equally strong stock in a weak group. It's like having the wind at your back. You want to be fishing in the pond where the fish are biting, you know?
Yeah, that makes perfect sense. Ride the wave of the whole industry. Okay, market, sector, then step 3.
Step 3 is finding the best individual stock pattern within those top-performing sectors. Look for that A-plus chart setup, the stock that has the cleanest stage 2 breakout potential.
So it's a funnel, broad market, then sector, then the specific stock.
Exactly. It filters out a huge amount of noise and focuses your attention on the highest probability opportunities.
Okay, talking charts. How critical is this idea of resistance?
Extremely critical. Think of resistance as a price ceiling. It's a level where the stock previously traded and then fell. There are investors who bought at that higher price and are now trapped.
Waiting to sell and get their money back if it ever gets back up there.
Precisely. So as the stock approaches that old high, those trapped sellers start unloading, creating overhead resistance that can stop or slow down the advance.
So what's the ideal situation then?
The most bullish scenario is when a stock breaks out into what Weinstein calls virgin territory. New all-time highs, or at least new multi-year highs.
Because there's no one trapped above.
Exactly. There's no overhead supply. The path is clear for potentially very rapid, significant gains. Think of it like breaking through the canopy into open sky.
Nice analogy. Now, you mentioned volume being key on breakouts. Let's nail that down. What counts as significant volume?
Yeah, volume is your gauge of buying power.
Yeah.
You absolutely need confirmation from volume. Significant generally means at least double the stock's average daily volume over the prior month happening on that breakout week. Or you might see volume building steadily over, say, 3 or 4 weeks leading up to the breakout.
So a sudden spike or a noticeable buildup.
Right. Without that strong volume, the breakout is suspect. It could easily be a head fake that fails quickly, no conviction behind the move.
Okay, got it. Price, volume. What about relative strength, RS?
Relative strength, or RS, is simply how a stock is performing compared to the overall market index, like the S&P 500.
Is it keeping pace, lagging, or leading?
Exactly. For a good buy candidate, you want to see its RS line improving, preferably already outperforming the market above the 0 line on an RS chart as it breaks out.
So avoid the laggards, even if they look cheap.
Definitely. Stocks with poor or declining RS are swimming against the current. They might go up in a bull market, but they'll likely underperform the leaders significantly. Stick with the stocks showing strength against their peers.
Okay, this sounds like you need to be watching closely for that exact breakout moment. What about using specific order types like buy stops?
Ah, yes. Buy stop orders are a really valuable tool, especially for discipline. It's an order you place with your broker above the current market price, typically just above the resistance level you want to see broken.
So it only triggers if the stock actually breaks out.
Precisely. If the stock hits that price, your buy order executes automatically. It takes the emotion out of it. You don't have to sit there watching it tick by tick, wondering if you should jump in.
Yeah.
You do your analysis, set the order, and let the market confirm your thesis.
Does it prevent chasing? Like if it gaps up way higher?
It helps. You can set a limit on your stop order too, but the main benefit is automating the entry once your condition the price breakout is met. Using good till canceled or GTC orders means you don't have to re-enter it every day. Set it and not quite forget it, but let it work.
That sounds like a much less stressful way to operate. Now, on the flip side, what's a huge buying mistake? A definite what not to buy.
The big one Weinstein hammers home is never, ever buy a stock that breaks above some minor resistance but is still trading below its declining 30-week moving average.
Even if it looks like it's starting to turn.
Even then, that declining long-term average is like an anchor dragging it down. It might bounce, sure, but it's highly likely to fail and head lower. It's not truly in stage 2 yet. It's a classic amateur trap.
Okay, noted. Declining MA is a red flag for buying. Are there specific chart patterns that are particularly good signals for a bottom for the start of stage 2?
Yes, there are a couple of powerful ones. Probably the most reliable, according to Weinstein, is the head and shoulders bottom.
Sounds dramatic. What does it look like?
It forms after a big decline. You get a bounce, that's the left shoulder, then a drop to a lower low, followed by another bounce, that's the head, then a final shallower dip and bounce, the right shoulder.
Okay, I can picture that. Where's the buy signal?
The buy signal comes when the price breaks above the neckline, a line drawn connecting the peaks between the shoulders. But crucially, the 30-week moving average should be flattening out or starting to rise by the time the neckline breaks, and the stock needs to clear that average too.
Got it. Head and shoulders bottom. What's the other?
A simpler one is the double bottom, sometimes called a double-barreled action. The stock hits a low, bounces, comes back down to test that same low area again, and then bounces decisively. You buy when it breaks above the peak of the bounce between those two lows.
Okay. And is there a general rule about the size of these patterns?
Absolutely. The bigger the base, the bigger the move. A stage 1 base that forms over many months or even years implies a lot more quiet accumulation has taken place. When that stock finally breaks out into stage 2, the subsequent advance is likely to be much more extensive and last longer than one breaking out of a short, shallow base.
Makes sense. More fuel in the tank. Okay, so we've bought well. Now, the arguably harder part, selling, protecting those profits. What are the big selling mistakes to avoid?
Oh, there are plenty. A big one is selling just because you have a nice profit. If the stock is still acting well in stage 2, let it run. Don't cut your winners short.
Easier said than done sometimes.
It is. Another is selling on good news. By the time really great news hits the headlines, the stock has often already priced it in, and it might actually be near a top.
So selling on good news can be too late. What else?
Holding onto a weakening stock just for the dividend? The potential capital loss in stage 4 almost always dwarfs any dividend yield you might collect.
Right, don't let the tail wag the dog.
Exactly. And the absolute cardinal sin.
Mm-hmm.
Never average down in a losing position. We mentioned it for stage 4, but it bears repeating. It turns small, manageable losses into potentially catastrophic ones.
Okay, underline that one. Never average down. What should people do instead?
Average up.
Ah.
If a stock you own is working, breaking out again, showing more strength, consider adding to your position. Reinforce success, don't reinforce failure.
Makes sense. So how do we sell systematically? How do we protect profits without cutting winners too short?
The key tool here is the sell stop order. It's the mirror image of the buy stop. You place an order below the current price. If the stock drops and hits that price, it automatically triggers a sell order.
Takes the emotion out of selling too.
Completely.
Yeah.
It helps you stick to your plan. For setting your initial stop loss right after you buy, you typically place it just below a recent significant low point within the stage 2 uptrend.
Okay.
And a little pro tip from Weinstein, try to place it just under a round number. Like if the support is around $50, place your stop at $49.75, $49.50.
Why is that?
Because lots of buy orders tend to cluster right at the round numbers. Placing your stop just below might prevent you from getting knocked out by a brief dip that just touches the round number before bouncing.
Clever. Okay, so that's the initial stop. What about as the stock goes up?
Then you use trailing stops. As the stock moves higher in stage 2, making new highs and pulling back, you methodically raise your sell stop order. You always keep it below the rising 30-week moving average and below the most recent significant reaction low.
So you're locking in more and more profit as it climbs.
Exactly. You're giving the stock room to wiggle and make normal pullbacks, but you're protecting the bulk of your gains. It lets you ride the trend without getting shaken out too easily.
But what about those whipsaws? Getting stopped out, then the stock immediately turns around and zooms higher without you. That sounds incredibly frustrating.
It is frustrating when it happens, no doubt about it. But Weinstein argues you have to think of those occasional whipsaws as the cost of insurance
Insurance against what?
against getting caught in a stage 4 collapse. That sell stop protects you from catastrophic losses. Paying a small premium in the form of an occasional whipsaw is far, far better than watching a 50% gain turn into a 50% loss because you didn't have a stop in place. If a stock stops you out, then sets up again, you can always rebuy it.
Okay, perspective is key there. It's risk management. Now, is there a difference in how a short-term trader versus a longer-term investor might use stops?
Yes, generally, a trader will usually use much tighter stops. They might exit on the first break of a minor trend line or any sign of lost momentum. An investor using Weinstein's method might give it more room, perhaps only selling if it violates the 30-week moving average or takes out a major prior low.
So it depends on your time horizon and risk tolerance.
Absolutely. You need to know yourself and what kind of market swings you can handle emotionally and financially.
It really seems like mastering the mental game, especially handling losses, is critical.
It's arguably the most important part. Weinstein really stresses this idea, learning how to win by learning how to lose. He strongly advises keeping a trading diary, but focus specifically on your losing trades.
Why the losers?
Because winning teaches you nothing, he says. Analyzing your losses helps you identify your recurring mistakes. Are you consistently buying too early, holding losers too long, averaging down, ignoring stops? That diary becomes your personalized instruction manual for improvement.
That's powerful advice. Okay, let's switch gears to something many find intimidating. Selling short. The idea you can profit when a stock goes down, people seem terrified of it.
Yeah, there's this huge myth around short selling. You can lose more than you invest, you'll lose the house.
Is that true?
Only if you're reckless. If you use a protective buy stop order on your short position, just like you use a sell stop on a long position, your risk is defined and limited upfront. It's no more inherently risky than buying a stock if you manage the risk properly.
Okay, so the risk can be managed. What are the common mistakes people make when they try to short?
A big one is shorting a stock just because it seems overvalued. Maybe it has a high PE ratio, or shorting just because it's gone up a lot. These stocks can, and often do, keep going much higher, causing a lot of pain for early shorts.
The dreaded short squeeze.
Exactly. Another mistake is jumping on what Weinstein calls sucker shorts. These are the stocks that everyone thinks are going to crash. They often have huge short interest already built up. These are prime candidates for squeezes before they ever actually break down.
So don't short the obvious candidates necessarily? Anything else?
Yeah, avoid shorting stocks that are very thinly traded. They can be hard to borrow and prone to erratic moves. And definitely don't short a stock that's in a very strong industry group, even if the individual stock looks weak. You want the wind at your back when shorting too, which means a weak market and a weak group.
Okay, so when is the right time to short? It's basically the mirror image of buying, right?
Pretty much. First, the overall market should ideally be in a confirmed downtrend, stage 4. Second, the industry group should be weak, also likely in stage 4. Third, the individual stock should have completed its stage 3 top and be breaking down below key support.
And the 30-week moving average?
Must be declining. And its relative strength should be poor, preferably negative, meaning it's underperforming the already weak market.
What about volume on the breakdown when shorting? You said it was different from buying.
Yes, this is a key difference. When buying, you absolutely want to see that high volume confirmation on the breakout. But when shorting, high volume on the breakdown is a bonus, but it's not necessary.
Why not?
Because stocks can fall much more easily than they rise. Fear is a more powerful motivator than greed. Stocks can drop sharply on relatively light volume as buyers just disappear. So a breakdown below support with a declining MA is a valid short signal, even if volume isn't huge.
Interesting nuance. How do you execute the short? Same idea with stop orders.
Yeah, you can short on the initial breakdown below support. Or sometimes a stock will break down, then have a brief rally back up towards that breakdown level, That can be another spot to initiate or add to a short. And absolutely use a buy-stop order above the breakdown level to limit your risk if you're wrong.
Are there chart patterns that are particularly good for shorting, like the head and shoulders bottom for buying?
Yes, the mirror image,
Yeah.
the head and shoulders top. This is considered the most reliable top formation. It forms after a strong advance. You get a peak, left shoulder, then a rally to a new higher peak, the head, often on less volume, then a decline, followed by a weaker rally that fails below the head right shoulder.
And the sell signal.
Is when the price breaks below the neckline, connecting the lows between the shoulders. And just like the bottom, Weinstein's rule applies. The bigger the top, the bigger the drop. A larger, wider topping pattern often leads to a more significant stage 4 decline.
And you'd use trailing buy stops to lock in profits as the short works.
Exactly. As the stock falls, you methodically lower your buy stop order, protecting your paper profits. Same principle as trailing sell stops on the long side.
This is fantastic for individual stocks. But you mentioned earlier that knowing the overall market trend is step one. How do we apply this stage analysis to the big picture to spot bull and bear markets?
Right, you can't just focus on individual trees. You need to know which way the forest is leaning. Weinstein uses what he calls a weight of the evidence approach, combining several indicators. But the foundation is applying stage analysis directly to the major market averages, like the Dow Jones Industrials or the S&P 500.
So if the Dow is in stage 4, breaking below its 30-week moving average.
That's a major warning sign. It signals a bear market is likely underway or imminent. Time to be defensive, sell long positions, and start looking for potential shorts. Conversely, when the Dow breaks out of a stage 1 base into stage 2, that's your signal to get aggressive on the long side. He showed how this clearly signaled the 1987 crash well in advance.
The market average itself tells the story. What other indicators add to the weight of the evidence?
A really important one is the advanced decline line, or AD line. It measures market breadth.
Breadth, meaning how many stocks are participating in the move.
Exactly. It's a running total of the number of stocks advancing minus the number declining each day on the NYSE. What you watch for are divergences. A negative divergence is a huge red flag.
What does that look like?
That's when the Dow, for instance, keeps making new highs, but the AD line fails to make new highs alongside it. It peaks before the index does.
What does that tell you?
It tells you the rally is narrowing, becoming less healthy. Only a handful of big stocks are pushing the average higher, while the average stock, the troops, are starting to retreat. It's a classic early warning sign of an impending market top. It happened clearly before the '87 crash.
Wow, so it measures the underlying health. What about the momentum index?
The MI is basically a smoothed, long-term version of the AD data, often a 200-day moving average of the daily advanced decline figures. It gauges the market's internal momentum or thrust.
How does it signal danger?
It gives early warnings, too. It's bearish when it starts dropping sharply from a high peak, even if it's still technically positive, and it signals real danger when it crosses below zero into negative territory. Again, this indicator peaked way back in mid-1986, giving a very long lead time before the Dow finally topped in '87.
So these internal indicators can show weakness long before the main index rolls over. That's fascinating. Also heard Stan used General Motors stock as an indicator. Seriously.
It sounds quirky, but yeah. Historically, GM's stock chart acted as a surprisingly effective bellwether for the overall economy and market. Its own stage 2 breakouts often coincided with or preceded major bull markets, and its stage 4 breakdowns often signaled bear markets. A simple, but often very accurate gauge back then.
Amazing. Any fundamental indicators in his toolkit?
He did look at the long-term price-dividend ratio for the overall market. This is just the market level divided by the dividends being paid out. Historically, very high readings, say above 26 or 30, suggested the market was significantly overvalued and potentially near a major top. Very low readings, like 14 to 17, suggested it was cheap and near a bottom.
So not a timing tool, but more for context.
Exactly. It helps gauge if you're in thin air or near bedrock, valuation-wise.
And finally, the theory of contrary opinion, going against the herd.
Right. This is more psychological. When market sentiment becomes overwhelmingly one-sided, either extreme optimism or extreme pessimism, the market is often poised to do the opposite.
How do you measure that?
Look at financial magazine covers, newspaper headlines, investor sentiment surveys. When everyone is proclaiming a new era of endless prosperity, be cautious. When magazine covers feature scary bears and predict doom, like in late 1974, it might actually be a screaming buy signal. As Weinstein puts it, when everybody knows something, it isn't worth knowing.
Love that. Okay, so this whole methodology, stage analysis, indicators, it's not just for stocks, is it? Can you apply it elsewhere?
Absolutely. Weinstein showed how you can apply it effectively to mutual funds. Use the 30-week moving average on your fund's chart. When it goes into stage 2, be in an aggressive stock fund. When it breaks down into stage 4, switch to a money market fund. It's a simple way to manage risk, especially in retirement accounts.
Great for hands-off investors. What about more aggressive traders? Options.
Yes, but with extreme caution. Options give you leverage, but they amplify risk dramatically. The rules are strict. Only buy calls on stocks that are solidly in stage 2, ideally breaking out. Only buy puts on stocks clearly in stage 4, breaking down.
It's yours carefully.
Definitely. Pick A-plus setups with big potential. Give yourself enough time, at least 45-50 days, ideally 3 months or more until expiration. Buy options that are slightly in the money or very close to the strike price. And use limit orders, never chase. Crucially, if the underlying stock's pattern starts to fail, get out of the option immediately. Don't wait.
High risk, high reward, strict rules, even futures.
Briefly, yes. He notes the same principles apply to futures, but the time frames are way faster. You'd likely use daily charts and maybe a 30-day moving average instead of weekly charts and the 30-week MA. Much more demanding.
This has been incredibly comprehensive, a really powerful, disciplined approach. So wrapping this up, what's the big picture for listeners?
The big picture is that consistent success in the market doesn't come from predictions or gut feelings. It comes from having a sound methodology and executing it with discipline. By applying these concepts, stage analysis, market group stock selection, specific patterns, and especially the disciplined use of stop-loss orders, you can stack the odds in your favor.
And significantly reduce those crippling losses that wipe so many people out.
Exactly. It's about making rational decisions based on objective evidence, removing the emotion, the fear, and greed that causes so many mistakes.
And that final piece of advice seems crucial. Keep that diary of your losses.
It really is.
Yeah.
Winning teaches you nothing. Understanding why you lost on a trade is where the real learning happens. It shines a light on your personal psychological traps so you can work to fix them.
So perhaps the final thought to leave everyone with is Stan Weinstein's own motto.
I think so. The tape tells all. Listen to the market. Read its action objectively. It's constantly giving you clues, telling you a story. Your job is just to learn its language.